Welcome, everyone. This is Corey Halliday with Maverick Trading, and today we're going to talk about yield curves and recessions. Do yield curves predict recessions? Well, actually, they have a pretty good track record for doing so, specifically an inverted yield curve, and we'll talk about what those different curvatures are, how they work, and how to make sense of them. So let's start by just talking about how yield curves work and what the curvature is and what it describes and shows and all those sorts of things. So first, as we talk about yield curves, we need to understand how what it's referencing in the bond market because bonds have yield, right? That's the amount of interest that they're paying. So the buyer of a bond sends their money out to somebody that is selling a bond who receives that money. And for the bond seller, the person that is selling bonds, in this case, we'll look at U.S. government debt. The U.S. government is taking your money in, the investor's money, and then promising to pay a certain yield, a certain interest rate for that. And so there's different time frames. We can look at a 2-year, we can look at a 10-year, we can look at let's go 20-year, and let's go 30-year. Now, the typical yield curve, kind of more normal yield curve, might look something like this, where it would have a certain steepness to it. The expectation would be that if I'm going to give someone my money for 30 years, they should pay me a higher rate of return than if I'm only giving them the money for 2 years and I get the money back in 2 years, right? So over here, you have kind of the duration we put up on the top. Well, here you might have the actual yield, and it might go from 0% to 1% to 2% to 3% to 4% and so on. And this is how much you're collecting, right? This is the percentage that you're receiving as an investor. And so we would expect that if we buy a 30-year bond, we're going to collect more interest than if we buy a 20-year and so forth, right? Tie up your money for longer. You have risk of inflation and other factors for that money that you're not able to use during that period of time, that you're not able to invest elsewhere. So usually you'll collect more interest. That's a more normal yield curve. Sometimes the yield curve is very flat, where there's just really not a whole lot of difference between what one is paying. Now, it's not inverted, but it's just really, really flat. There's just not a whole lot of difference between one versus another. Now, it might be a little steeper than that, but the point is, sometimes the yield curve is just very flat. You collect about 2% at any of these durations. Sometimes the yield curve is very steep. And so you would have a lot of variance where, a 2-year might pay 1% and a 30-year pays 5%. A steep yield curve is historically very good for financial companies because they're in the business of selling short term and buying long term, in terms of what they're doing and kind of the approach. In other words, they have to pay interest in short term, but they get to collect interest in the long term. Why is that the case? Well, a bank basically pays for deposits, right? They pay you a little bit of interest on your savings account. But that money that you put in your savings account, they're going to go and make loans against it. And they're going to make 30-year mortgage loans. And so they're collecting a higher rate and they're paying you little tiny rates for the money in your savings account. And the differential is a profit margin. If you can put your money in the savings account, they only have to pay you 1%, and then they go and make a mortgage loan and they get to collect 5%. The difference is a 4% profit, right? And so financial companies really like a steeper yield curve. A flat yield curve doesn't create as much profit potential for them. Then finally, last but not least, an inverted yield curve would be, more rare, but would basically go the opposite way. It's backwards, to use a futures term. If you've ever studied the futures market, there's backwardation and contango are the two terms. Now, I think that's kind of a helpful topic to kind of describe what's happening. In the futures markets, a barrel of oil, commodities, one commodity is the same as another, right? A bushel of corn, a bushel of wheat or whatnot, it's all the same. One bushel of wheat is just as good as another bushel of wheat. One uh, one barrel of oil is just as good as another barrel of oil, and so forth. So let's take oil as an example. In the oil markets, you might have different futures uh, time periods. So let's say there's a November and maybe an October and a July and so forth. And so there's these different expirations. And the way that oil prices is normally in contango. So if a barrel of oil is going for $100 in July, we'd expect it to be a little bit more expensive in October and maybe a little bit more expensive than that in November. That is what they call contango or normal pricing. Backwardation is if that goes backwards, and it's kind of like an inverted yield curve. It's abnormal. So what would be an example of backwardation in the futures markets? Well, backwardation happens when you have the longer term priced below. So it's a barrel of oil costs 99 out here, it costs 100 here, and it costs 102 for the front month. Now, why would this barrel of oil be more expensive than these? Well, it's backwards to normal, but maybe there was a supply disruption. It's probably a short-term issue, but they can't just create more oil out of nothing, right? It takes time to ramp up and open up new supply and to bring supply on the market. So the market might say, well, we just don't have enough oil right now. There could have been a terrorist action or Russia invading Ukraine and that takes off some of the Russian supply or whatever. Prices can get expensive in the short term, but everybody says, well, by November, we can ramp up our supply. We can open up new areas, we can get some rigs working, et cetera, et cetera. So we can solve it over time, but we can't solve it in the short term. And so prices get expensive in the short term because people need the oil, they're willing to pay more, but we know that it will be resolved in the future, right? And so it's backwards. That's kind of how an inverted yield curve looks. Is for it to go inverted means that a 2-year bond is paying you more in interest than a 10-year bond, which might be paying you, 2.8%. Why would I give my money to someone for 10 years and collect that when I could give it to them for 2 years and collect this? Well, it's backwards to normal, but there are some advantages here. One is you get your money back sooner, right? Here I've got to leave my money in there for 10 years. Now you could always sell the bond and so on, but the point being, there is the ability to get my money back in this one a little quicker, where here it might be tied up for more time, and I'm locking in at this rate versus that one. It's an inverted yield curve, it's backwards, and this type of dynamic shows a certain amount of stress in the market. Just like oil going backwardated, it's that there's stress in the market. There's not enough supply. Something went wrong, and so prices went backwards. Here it's kind of the same concept. Something is off in the markets. Now, this is not, when you get an inverted yield curve, it's not like a recession is imminent. It's not like the next day or the next week a recession hits. In fact, it usually is a leading indicator, and it's about 1 to 1.5 years in advance of the recession. But it really does a good job. When you have an inverted yield curve, it shows that there's a certain layer of stress. And the way that I would explain that is dominoes. It's kind of that something's going wrong, and like dominoes, when one topples over, it can impact the next one, which hits the next one, and so on. And all of a sudden, you have things spiraling a little bit. And that's how recessions happen. First, it happens with something going wrong. Their supply chain gets disrupted, yada, yada, yada. Prices spike. Now prices are too high. The consumer gets hurt, doesn't have enough to spend. All of a sudden, you've got stress in the system. Something has gone wrong and the dominoes are starting to kind of topple over. So we just had an inverted yield curve that happened month and a half ago or so. Again, it's a leading indicator that suggests that maybe a recession is coming. So in order to look at, let me just pull this up. We'll just go to Google and you could say current Treasury yield curve. I'll just do a Google search, okay? And you can see right there, just front page of Google, you can see what the current yields are. And you can see we're not in an inverted state right now. Okay, that's more normal pricing. There's not a huge difference. It's not super steep, but you can see that the 30 year is paying about 3%, 2.7 for a 10, 2.5. You could even click on some of these and see a graph of it, but we have a little bit of steepness to the curve. Not massive, but here's the current in blue, and you can see a certain steepness to it. Here you can see how it was this same time last year and then the year before that. So rates have gone up. First of all, we can see that we're at higher rates than where we were last year, which was higher than the year before. We can see that there was a certain steepness, and we can also see that within the yield curve, there was an inversion. There was an inverted state that kind of went inverted temporarily. It went a little backwards, it went a little haywire. If you extrapolate that out, as they say here, an inverted yield curve has predicted the past 7 recessions. It happens first, and then a recession kind of follows thereafter. Now, I don't know that it's, historically perfectly accurate. It's not, but it does show that there's a certain layer of stress and you have that risk of dominoes. So would I expect that we're going to move into a recession next year? I think that's kind of where we're headed. We're kind of in this a little bit of a stagflationary environment. The economy is kind of stagnating and inflation's still a big problem. Um, this to me is not a perfect predictor of the recession, but it does tell me something of that's informative, that there was stress in the marketplace, right? That something abnormal is taking place and kind of toppling over to the next one. So we had a little bit of an inverted yield curve signal. An economic recession in 2023 is very much a real possibility. Stocks are going to have to deal with that, and they're already pricing that in with a deeper decline. The stock market's down 20% so far. We might see another, 10, 15, 20% before this thing's all said and done. What's tricky about it is that by the time the recession hits, and you're in the midst of that, that's probably where the market bottoms out. When the worst of the news is there and everyone goes, oh boy, this is horrendous, this is terrible, that's probably about where the market bottoms. It's kind of backwards to how you might think of it, but a lot of times it's when things look the worst, that's when it's kind of the market's finally hit its bottom. Everyone that's willing to sell has sold, they've moved out, and now stocks can kind of pick themselves up off the ground and work their way higher. Hope you've enjoyed this presentation on yield curves and recessions. Visit us at maverickTrading.com. Click the link to subscribe and get more content like this. We'll see you next time. Goodbye, everyone.